Hey guys, just a quick tutorial for you on the RSI Stochastics oscillators. So if you look at the lower half of my chart, you'll see the white line, which is the relative strength index, or RSI. This is calculated by taking the average gain and dividing it by the average loss over the last 14 candles. The stochastic is calculated by taking the closing price, subtracting the lowest low, and dividing that by the highest high minus the lowest low of the last 14 candles. As you'll see when you look at these two lines, is that they make a very similar pattern, and that's because they show the same thing. They're showing you the momentum or the strength of the trend. If you see the oscillator lines get above these purple rectangles, that means you've got a very strong bullish trend, but it also means that they are overbought, so there may not be that much left in the move. But as you can also see, they've both been well above this purple rectangle for quite some time, and the price has continued to go up. What traders typically look for with both the oscillators is that the price is going up, but the oscillators are going flat or starting to go down. This is known as divergence and is a signal that the trend may be about to reverse and is getting exhausted. I hope that helps clear a few things up for you. See you next time.